So this is pro rata distributions problem 1. We have Edible Arrangement LLC is a cash method calendar year LLC with 3 equal members, Cantaloupe, Honeydew, and Pineapple. I'm just going to call them C, H, and P. C, H, and P. LLC has no liabilities, and here are the assets: cash, accounts receivable, inventory, land held for investment, and it gives you the total basis and fair market value. So a very, very, very simple example. Assume the adjusted bases of C, H, and P, Cantaloupe, Honeydew, Watermelon, for their ownership interests are 40, 30, and 20 respectively. So Cantaloupe is 40, Honeydew is 30, and Pineapple is 20. What are the tax consequences to the LLC and the owners if the LLC, and we have 4 different independent situations, A, B, C, and D. 4 different independent situations here, okay? So we know that if you look at the different choices, we know it's a distribution because in the problem it says, hey, distribution, distributes. So right there, you need to understand, you need to apply the distribution rules. So remember, the code sections that apply to distribution from subchapter K, we have 731, 732, 733. We also have 751B. Okay? Now 731 deals with the gain or loss recognition by the partners. It says no gain or loss is recognized by the partnership if it's pro rata. Now I told you that these problems are pro rata distributions, but I'm going to show you how they're pro rata and how you test, because you might not have an example on a question where the teacher says, hey, this is pro rata. You might have to figure that out. So 731 says the partnership has no gain or loss if it's pro rata distribution. For the partner, it depends. We're going to go through some examples of where they might have gain, they might not, or loss. Either this problem or the next problem. 732, so 731 is the gain or loss. 732 is the adjusted basis the partner takes in the distributed property. 733 is the outside basis a partner has in the partnership interest if it's a non-liquidating distribution. And 751B applies if it's a disproportionate distribution. Disproportionate distribution. So whenever you know a problem deals with distributions, the first thing you always want to do is determine if it's going to be pro rata or not pro rata, also known as disproportionate, because the tax consequences are going to be drastically different, and the way we analyze is drastically different. Now, there is some overlap of application, because if you're disproportionate, they'll rely on the pro rata rules, but pro rata does not rely on disproportionate rules. Okay? So the way that we determine if it's pro rata or disproportionate is we look at each different alternative distribution situation, and we see, does the owner or the partner, does the partner get their share of hot assets using fair market value in distribution or left over if they still own an interest? The idea is, if we have some hot assets. So hot assets, for purposes of this analysis, accounts receivable is a hot asset. Substantially appreciated inventory. So this is under 751B. So it's not all inventory. It's only substantially appreciated inventory goes into this. Okay, and that is if you take 120% of the adjusted basis, and that amount the fair market value is greater than 120% of adjusted basis. So here, the inventory is a 90 fair market value. If we take 1.2 of 60, we get, what is that, 72? Is 90 greater than 72? Yes. And when you have substantially appreciated inventory, you include it in this analysis. Okay? If it wasn't, you would not include it. It would just be the accounts receivable. And the issue is, you look at before and after. If a partner is leaving the partnership and they were to leave this partnership without receiving any of the hot assets, ordinary income assets, that would be disproportionate. Okay? And the reason why is because hot assets are going to create ordinary income or ordinary loss later on. And if a partner leaves without having to record that, that is a bad situation. So disproportionate distributions require that we have to record potentially gain, ordinary gain to the partner hypothetically in that situation. So here in this situation, let's just look at A. We'll go through each of these just to test this rule. So in A, the partnership makes a cash distribution of $20 to each owner and also distributes an undivided 1/3 interest in the land to each owner. So before, they all own 1/3 of each of the assets. After, they're each receiving cash. Is cash a hot asset? No. Is the land a hot asset, which is held for investment? No, it's a capital asset to the partnership. So afterwards, do they still have the same ownership in the hot assets, the accounts receivable and inventory? Yes, they do. So that means that it's not a disproportionate, it's a pro rata distribution. That's what you're asking. Okay? What you do is you take 1/3 of the fair market value of the accounts receivable. So 1/3 of accounts receivable is 10. And then 1/3 of the inventory, 30. They need to have that amount before and after. So before, they each own 10 and 30 of the assets, of those hot assets. After, they still own 10 and 30, right? If their amount changes, like if it went from 10 to 5, but they didn't actually record ordinary income, that's when this disproportionate stuff, the red flags pop up. So in A, before they own 10 and 30. After, they still own 10 and 30 because they still own an ownership, right? This is not a liquidating distribution. C, right, cantaloupe, honeydew, and watermelon are not liquidating. For it to be a liquidating distribution, you have to be told, hey, cantaloupe, honeydew, watermelon no longer have an interest afterwards. Or this is an entire liquidation of their interest. They're getting these assets in exchange for their entire interest. So A is pro rata, right, because they still own that same fair market value portion. And you focus on fair market value. And B makes a distribution of $10 in cash, not a hot asset, 1/3 of inventory, and 1/3 of the land. They're receiving 1/3, which is their portion of the inventory. They still own 1/3 of the accounts receivable because they still own that portion of the partnership. So before and after, do they still own the same thing in terms of the hot assets? Yes. Because they're receiving the inventory now. They're each receiving 1/3 of it. So they're each getting $30 of inventory. So now they have $10 of cash, 1/3 inventory, 1/3 land, and they also own the partnership, which also owns 1/3 of the accounts receivable and cash. So they're still good. So you're testing that. Do they own exactly before and exactly after the same? If it changes, that's when it's bad. C, makes a distribution to each owner of $10 in cash, 1/3 of accounts receivable, and 1/3 of inventory. So before, they each own $10 of accounts receivable, $30 of inventory. After, they each own the partnership interest, 1/3 of, right, which has land and some stuff in it. And then they also have 1/3 of accounts receivable, 1/3 of inventory. So again, they're good. So pro rata, pro rata, pro rata. Finally, D distributes $45 cash to cantaloupe and distributes 1/2 of the land to honeydew and watermelon. Honeydew and pineapple. Is it still pro rata? Yes. Because they all own 1/3 of the partnership. The partnership is the one that has the inventory and the accounts receivable. So therefore, it's still considered 1/3 and 1/3, right? 10 and 30 of each before and after. Now, if I told you in D that Cantaloupe gets $45 in cash and Honeydew and Pineapple get 1/2 and 1/2 of the inventory, that would be a disproportionate distribution. Because now Cantaloupe gets 45 of cash, and that inventory now goes to 0 for Cantaloupe. Honeydew and Pineapple go up. They had a $30 portion of inventory, now they go up to 45. So that's an example of a disproportionate distribution, but we don't have that here. So all these transactions are all pro rata. So that's the first thing to test. Again, the way we test that is we take the fair market values of the hot assets, right? For inventory, it's only substantially appreciated, and we ask, hey, before, what do they own? We focus on the fair market value, take 1/3 of that. What do they own after? Viewing what the partnership owns and their ownership in that, if they still own any ownership in it, and what they actually got. And it's equal. 10 and 30, 10 and 30 in each situation. Okay, so now that we've done the pro rata versus disproportionate analysis, determine that, hey, in all of these, they're pro rata. Now, we don't have to worry about 751 in this question. It's just going to be 731, 732, 733. Okay, so now what we do is we're going to create a chart. Okay, we're going to create a chart that I like to use when it comes to pro rata distributions. And the way I'm going to do this is we've got A, B, C, and D. So I'm going to go ahead and I'm going to create four different alternatives, right? We've got A, B, C, and D, just like you have here in front of you. Okay? And the way this chart works, and I have a video that goes over this chart. So the chart, we've got the rules for simple distributions, and we have our waterfall rules for simple distributions. This is where the chart comes into play, right here, this three-tier system. And also, it's important to note that because this is a non-liquidating distribution, right, because there's an interest left over, we also have to allocate to the last item is the partnership interest, right? The partnership interest left over. So keep that in mind. All right. So let's go ahead and start this. Let's start off A. The way we do this is we start with the outside basis given to us in the problem. So the outside adjusted basis given to us in the problem. I'm just going to go ahead and write that out for all of these situations because it's all going to be the same. Again, it's 40, 30, and 20. I'm going to change the font as we go in each of these, but I'm just going to leave this one the same color. Or change the color of, not the font. So 40, 30, 20. We now are going to apply our tiers, looking at what they're receiving. Now, keep in mind, there's no gain or loss to the partnership. You can only have gain to the partners. So right there, we know, okay, because it's a pro rata distribution, this partnership in this problem, Edible Arrangement, LLC, under Section 731, reports no gain or loss. The only time the partner is going to have gain is if they receive cash, so it has to be cash distribution, and it exceeds the outside basis, right? 40, 30, 20, that amount. So we'll see a situation where that occurs. Only time we can have a loss is if it's a liquidating distribution, which, hey, it's not liquidating, so we're not going to have that in this case. So we can't have loss. The partners cannot have a loss in this situation. We're going to apply the waterfalls in this order. We're going to go down, allocating out our basis. And again, seeing if we have gain. Those are our two steps. We're determining, there's two questions being asked here. Do the partners have gain or loss? Again, we can't have loss, we only have gain. And also, what's the basis in the assets they get? So we're told in A, we're starting with A, we're just going to use black for A, that the partnership makes a cash distribution of $20 to each owner and also distributes an undivided 1/3 interest in the land to each owner. Okay? So they're receiving two things. They're receiving cash distribution of $20 and 1/3 interest of land to the owner. 1/3 each of land. So we start with tier 1, cash. So they each are getting $20 of cash. So we're going to subtract away $20 of cash. So that brings us down to a subtotal. Now, if this subtotal is negative, we have gain. And that's when we record it right here. But the subtotal is 20, 10, and 0, so there's no gain. So no gain in A by the partners. So no gain, recorded in A. Then we do subtotal again before we go to tier 2. So we bring that down, 20, 10, and 0. Now we go to tier 2. Tier 2 are the hot assets. Now, this is where you gotta be careful. For our pro rata disproportionate distribution calculation, for the inventory, it only applied if it was substantially appreciated inventory. For tier 2 analysis, it's all ordinary income assets, ordinary loss assets. That's all inventory. So that's where you can have this discrepancy. You got to be really careful there. So we already went through the cash, $20 of cash, and then and then 1/3 of land. Is the land a hot asset? No, because it's held for investment. To the partnership, it's a capital asset. It's a capital asset, therefore it's not considered an ordinary income tier 2 asset. That would be the accounts receivable and inventory here, right? That would be the tier 2 assets. Land held for investment is tier 3. So we have no tier 2 assets. Now, I'm going to leave some space here because later problems, we might have to go further on. Okay? Put subtotal. Now we go to tier 3, right? Each of them receive 1/3 of land. So let's look at our rules. We had tier 1, we did that. Tier 2, we had no tier 2, go tier 3. If non-liquidating, it's the same rule as tier 2. The rule is we're going to carry out the inside basis, the lesser of the inside basis of the partnership or the outside basis the partner has. So what do I mean with that? The first time you see this rule, it takes a little bit of understanding, but after that, it's pretty easy. So we're taking the inside basis the partnership has, not the fair market value, use the inside basis. We're going to multiply that. They each receive 1/3. So 30 times 1/3 equals 10. So the rule is the lesser of 10 or their basis in the partnership at that time. So for C, it's the lesser of the partnership's inside basis of 10, right, because it's 1/3, or 20, so that's going to be 10. For H, it's lesser of 10, or 10 is, of course, 10. And then for P, pineapple, it's the lesser of 0 or 10, which is 0. So what we're doing here is under 733, we're determining the basis of the land. Now that also is going to reduce the basis left over, but that's the basis of the land. And that brings us down to the adjusted basis of the partnership interest left over. So 20 minus 10. Sorry, I put 733 there. That's 732. I jumped the gun. This is 733. 733 is the adjusted basis of the partnership interest. 732 is the adjusted basis of property received. So we take 20 minus 10, we subtract away. We get 10, 0, and 0. So the idea here is there's no gain to the partnership, no gain or loss to the partnership under 731, right? We saw that, okay? There's no gain to the partners because the cash does not exceed the outside basis as of the ordering of up in the level 1 waterfall. So no gain or loss. 732, the land's basis is 10 to cantaloupe, 10 to honeydew, and 0 to pineapple. And then the adjusted basis left over is 10 to cantaloupe, 0 to honeydew, and 0 to pineapple. That's basically what you're determining. You're going through those steps. All right, so now we're moving on to B. So once you go through the quick one there, it's pretty fast. So now we go to B. In B, we're told makes a distribution of $10 of cash, 1/3 inventory, and 1/3 of the land. Okay, so cash, 10, 10, and 10. So we got 30, 20, 10. So because there's no negative, there's no gain. We bring down that amount. So no gain or loss to the partnership. No gain or loss to the partners, because remember, this is not a liquidating distribution. This is non-liquidating. So you can't have a loss, and we just determined you can't have a gain because they have enough basis for the cash. Now we go down to tier 2 assets. Do we have any tier 2 assets? Yes. Remember, tier 2 assets, the inventory and accounts receivable, they're each getting 1/3 of the inventory. So we look at the inventory. We're going to put inventory here. Remember, the rule is from our list, like we saw with the land, the rule is it's the lesser of the partnership's inside basis, but you do 1/3 of it, right? Or the outside basis of the partner at that time. So inventory has an inside basis of 60. So we're going to take 60 times 1/3. 60 times 1/3 is 20. So it's the lesser of 20 or the basis, whatever the partner has at that time. So, of course, the lesser of 20 and 20 is going to be, lesser of 30 and 20 for cantaloupe is going to be 20. Lesser of 20 and 20 for honeydew is 20. Lesser of 10 and 20 is 10. There's no other ordinary income assets, tier 2 assets, because that's in this problem because all there is left is land. So we can bring that down, and that brings a subtotal of 10, 0, and 0. And this also gives us our 732 basis of the land right there. So if you ask what the basis is, you got that. And now we have the 1/3 land. Remember, we already calculated that. They're each receiving 1/3 land. So the rule is it's the lesser of the inside basis of the partnership, which is 30 times 1/3. We calculated that already. That's the 10. Or the partner's outside basis. So lesser of 10 and 10 is, of course, 10. Lesser of 0 and 10 is 0. Lesser of 0 and 10 is 0. And we are done. We got the basis for the land now in B, and we got the basis of the partnership interest. Now we go on to C. In C, change the color. In C, we've got $10 in cash, 1/3 accounts receivable, and 1/3 inventory. So we're going to go ahead and do the $10 of cash again. No gain or loss to the partnership. No gain or loss to the partners. Just bring that down, same analysis, right? Because there's no negative. Now we have 1/3 of accounts receivable and 1/3 of inventory. Well, the accounts receivable basis is 0. 0 times 1/3 is 0. So, you're limited to 0 anyway, so you can go ahead and put that down. 0, 0, 0. The inventory is going to be the lesser of the 20 or the outside basis after tier 1. So the lesser of 30 and 20 is 20. The lesser of 20 and 20 is 20. Lesser of 20 and 10 is 10. So we get their bases for inventory and accounts receivable there. We bring down a subtotal of 10, 0, and 0. And they have no land. No land received. So no tier 3. So we bring down the remaining basis of their partnership interest, which will be 10, 0, and 0. Okay. So that answers for C there. That's the 733 partnership interest as given. As calculated, 10, 0, and 0. Finally, D, change up the color. D, Cantaloupe receives $45 cash, and the other ones receive no cash, and then they each receive, the other two, Honeydew, Pineapple, receive 1/2 of the land. So we do 45 minus 45, 0, and 0. So right there, we got -5. If this is negative, we have gain. So it's going to be, in this situation, Cantaloupe has a $5 capital gain. Long-term capital gain, assuming that's been held for more than a year, the partnership interest. Okay, so that's $5 of gain. So I'm going to put a little arrow. There's $5 of capital gain, right? If I told you that the partnership interest held more than a year, it'd be long-term capital gain. Let's assume it's long-term capital gain here held for more than a year. You have to calculate that. The other ones don't receive any cash. So that brings Cantaloupe's basis to 0. Honeydew and Pineapple have 30 and 20 basis. Nobody receives any tier 2 assets in this problem because it's just cash and land. So then we go down, we bring down the 0, 30, and 20. So now we have 1/2 of land. So the basis of the land was 30. So 30 times 1/2 is 15. So it's the lesser of, well, count receives nothing. It's the lesser of the 30 or 15. It's going to be a 15. Makes 15 here. Lesser of 15 and 20 is 15. And that is the basis for the partnership interest as well as the basis in the land. All right, so this gives us the consequences. So A, B, and C, there was no gain or loss to the partners or the partnership. In D, there was a gain of $5 long-term capital gain to Cantaloupe, but Honeydew and Pineapple, no gain or loss. And then, remember, we looked at anywhere it says 732, we calculated the basis at that time in the asset. That's that row. Yes, it's a subtraction, but that's actually the basis you take in the asset. Finally, 733 is the basis in the end, in the partnership interest. One thing I want to mention is the rules, when it's pro rata, they make it very, very flexible for no gain or loss to be recognized by the partners. That was intended by Congress. Versus on corporations, when they liquidate and they distribute out property, gain has to be recorded under Section 311 when for appreciated property. We're going to talk about that, and you'll see that in a later video dealing with choice of entity. That's an advantage of partnership taxation over corporate taxation, both S and C corporations, so keep that in mind. All right, so please consider the other pro rata videos as well as the disproportionate videos on this issue.